The screen glows red. Again. You feel that familiar, cold knot tightening in your stomach. It's your eighth loss in a row. 8 times you followed your plan. 8 times you managed your risk. And 8 times the market just said no. Your cursor hovers over the buy button for the next setup, but your hand is shaking. A voice in your head, a primal whisper, is screaming at you. What if this is the ninth? What if the system is broken? What if I'm the one who's broken? That feeling, that icy grip of doubt and fear, that is the silent killer of trading careers. And today, I'm going to tell you that it's not your fault. You've been programmed for this failure. You've been handed a map that leads directly off a cliff by the very people who claim to be your guides. Because professional trading firms, the ones with skyscrapers and billion-dollar balance sheets, they don't trade like this. They don't worship at the altar of the 3-to-1 risk-to-reward ratio. Yet, every YouTube guru, every online course, preaches it like gospel. Today, we're going to shatter that gospel. We're going to dive deep into the brutal, uncomfortable truth of why the smartest sounding advice, never risk more than you stand to gain, is actually a psychological weapon designed to destroy you. And I'll show you what the real professionals do instead. This isn't just about math. This is about your mind, your money, and your future. Let's call it the golden rule of retail trading. Your risk-to-reward ratio should be at least 2-to-1, ideally 3-to-1 or higher. The logic is seductive, isn't it? It feels safe, responsible. If you risk $100 to make $300, you only need to be right 25% of the time to break even. Anything more, and you're printing money. It's a beautiful, clean equation. It fits perfectly on a PowerPoint slide. And that's the problem. The market isn't a PowerPoint slide. It's a chaotic, emotional battlefield. And that simple, beautiful math completely ignores the most volatile variable in the entire equation: you. The human being sitting in the chair with a brain wired for survival, not for statistical probability. This 3-to-1 dogma persists because it's an easy sell. It makes trading sound like a simple game of odds, where you can afford to be wrong most of the time and still come out a hero. It sells courses, it gets clicks, but it conveniently forgets to mention the price of admission: the long, soul-crushing, account-draining losing streaks that are not just possible, but a mathematical certainty. So let's stop talking about spreadsheets and start talking about reality. Let's talk about what happens to your brain, your biology, and your bank account when you're living through the brutal reality of that 3-to-1 system. Let's paint a picture with two traders. We'll call them Mike and Sarah. Mike is a devout follower of the 3-to-1 religion. He hunts for those perfect high-reward setups. He risks $100 to make $300. As a result, his system has a win rate of 35%. On paper, his expected value is positive. He's a winner, statistically. Sarah, on the other hand, trades a much more modest system, a 1-to-1 risk to reward. She risks $100 to make $100. Because her target is closer and more attainable, her system has a 55% win rate. On paper, she's also profitable. The YouTube gurus would look at this and say, Mike is the superior trader. He has the discipline to wait for the home run. Sarah is just playing for small ball. But here's the lie. The spreadsheet assumes Mike and Sarah are robots. It assumes that after Mike loses his 7th trade in a row, he will execute the 8th trade with the exact same ice-cold precision as he did the first. Let me ask you, honestly, can you do that? Because if Mike only wins 35% of his trades, that means he is losing 65% of the time. 2 out of every 3 times he puts his capital on the line, he takes a punch. Think about that. Most of his days are spent in the red. Most of his weeks are spent clawing back from a drawdown. Sarah wins more than she loses. She gets consistent, positive feedback. Her losing streaks are short and shallow. A bad day for Sarah might be 3 losses in a row. A bad day for Mike is a Tuesday. The spreadsheet says they're both profitable, but reality says only one of them is going to survive. To understand why, we have to go deeper. We have to look under the hood, at what's happening inside your own skull. Your brain is not a calculator. It's a 100,000-year-old survival machine. And when you force it through a 3-to-1 trading system, you are triggering ancient alarms that it was never designed to handle. First, let's talk about reward prediction error. Your brain releases a satisfying hit of dopamine, not just when you win, but when the outcome is better than expected. A 55% win rate system like Sarah's creates a stable, predictable dopamine environment. You expect to win about half the time, and you do. Your brain stays balanced. You remain the CEO, making rational decisions. Mike's 35% win rate system creates a dopamine casino. You go on long, draining streaks with no reward, your brain starving for a win. Then, bam, a big 3R winner hits. The dopamine rush is massive, just like hitting a jackpot. This creates a gambler's mindset. You start chasing that high, enduring the pain just for the next hit. This isn't trading, it's an addiction cycle, but it gets worse. Research from MIT shows that consecutive losses trigger a physiological threat response. Your body is flooded with cortisol, the stress hormone. Your heart rate spikes, your palms sweat. Crucially, this flood of cortisol does something terrifying to your brain. It decreases activity in your prefrontal cortex, the CEO, the rational thinker, the part of your brain that understands your trading plan. Simultaneously, it cranks up the activity in your amygdala, the primitive emotional fight or flight center. In plain English, losing repeatedly makes you literally dumber and more scared. The very part of your brain you need to execute your edge is taken offline, hijacked by a terrified caveman who only wants the pain to stop. This leads us to the most dangerous state for a trader: learned helplessness. After 10 consecutive losses, even if they are statistically normal for your system, your brain doesn't see statistics. It sees a pattern of failure. It starts to believe that your actions don't matter, that you are powerless. And what happens when a trader feels powerless? They either quit entirely or they go into full revenge trading mode, throwing caution to the wind because what does it matter anyway? This is the psychological death spiral. And the 3-to-1 system isn't just susceptible to it, it is the engine of it. Let's go back to Sarah and Mike and see how this plays out over a month. He starts the week with 3 straight losses, down 3%. He feels the pressure, he finds a great 3-to-1 setup, and it hits. Boom, back to break even. He feels euphoric. The next day, 4 more losses, down 4% from his high. He spends the weekend agonizing over his charts, questioning everything. The next week, he endures a streak of 8 straight losses. He's now down 12% from his peak. He's terrified. He's angry. He skips a perfect A-plus setup because he's too scared to pull the trigger. Of course, that one would have been a massive winner. He ends the month up 2%, but he feels like he's been through a war. He's exhausted, emotionally frayed, and dreading the next month. His equity curve looks like a heart attack on a graph. She starts the week with a win, then 2 losses, then 2 wins. She's up about 1%. Her longest losing streak all month is 4 trades, a 4% drawdown. It's uncomfortable but manageable. She never questions her system because she gets a winning trade before the doubt can fully take root. She is consistently banking small profits. Her wins activate the winner's effect, a neurological phenomenon where success increases testosterone, which in turn boosts confidence and pattern recognition. She's not just making money, she's getting smarter and more confident with every trade. She ends the month up 6%, calmly, confidently. Her equity curve isn't a straight line to the moon, but it's a steady, beautiful staircase. Mike is riding a terrifying roller coaster in the dark, hoping for a big spike. Sarah is calmly walking up a staircase, one step at a time, knowing exactly where she's going. Who do you think has a career in this business? Nowhere does this distinction become more brutal than in the world of prop firm challenges. The prop firm challenge is not a test of your long-term profitability, it is a test of your short-term volatility. They give you a tight window and a hard limit, usually a 10% maximum drawdown. It's a guillotine hanging over your account. Let's put Mike and Sarah in a $100,000 challenge. They both risk 1%, $1,000 per trade. Mike, with his 35% win rate, is statistically guaranteed to face losing streaks of 8, 9, even 10 plus trades multiple times a year. Just one streak of 8 losses puts him at an 8% drawdown. He now has only 2% of breathing room. He is one bad day away from failing. The pressure is immense. He starts trade saving, moving his stop loss, taking profits too early, all the things that destroy his edge, because the fear of that guillotine is overwhelming. Monte Carlo simulations are devastatingly clear on this. A 3-to-1 system like Mike's has less than a 40% chance of passing a standard prop firm challenge without hitting the drawdown limit. Sarah, with her 55% win rate, faces a 4-loss streak at worst, a 4% drawdown. She has 6% of breathing room. She can trade freely, without fear, executing her plan. Her system has over a 70% chance of passing the challenge. The prop firms know this. Their business model thrives on the churn of traders like Mike, who pay for resets over and over, trapped in a cycle of hope and failure, ground down by the very system the gurus told them to use. The prop firm is the meat grinder, and the 3-to-1 system is the meat. So if the gurus are wrong, what do the real professionals do? The traders at firms like Jane Street, SMB Capital, DRW, they obsess over one thing above all else: win rate. High probability execution. They don't hunt for home runs. They build their empires on singles and doubles. They look for trades where they have a clear, demonstrable edge, and they hit it again and again and again. Their secret weapon isn't a magical risk to reward ratio, it's compounding a high probability edge. A professional trader would rather take a 1-to-1 trade with a 60% win rate than a 3-to-1 trade with a 35% win rate every single day of the week. Why? 1. Psychological capital. They know their mind is their greatest asset. They protect it fiercely by creating a smooth equity curve and avoiding deep psychological drawdowns. 2. Scalability. When they find a high probability, high win rate setup, they don't just take the trade, they scale into it with massive size. They know where they're most likely to be right, and they bet big there. You can't scale size effectively on a low win rate system because the drawdowns would be catastrophic. 3. Data and learning. Sarah, taking 30 trades a month, is learning 3 times faster than Mike, who only finds 10 of his perfect setups. More trades mean more data, faster adaptation, and a quicker path to mastery. The pros aren't trying to be heroes on one trade. They are trying to be profitable, consistently, over thousands of trades. Their goal is a boring, predictable, upward-sloping equity curve. Because boring is scalable, boring is sustainable. Boring is how you build generational wealth in this game. Now, am I saying that you should never take a trade with a high risk to reward ratio? Of course not. Context is everything. If you are a long-term position trader, playing moves on weekly or monthly charts, a 3-to-1 or even 5-to-1 ratio might be perfectly logical. The market has more time and space to move. If you are in a screaming, powerful trend and you are trailing your stop loss, you might enter a trade targeting 1-to-1 and end up with a 4-to-1 winner. That's not chasing a ratio, that's excellent trade management. The poison is not the ratio itself. The poison is the dogma, the rigid, inflexible rule that you should only hunt for these setups, rejecting perfectly good, high-probability trades simply because they don't meet an arbitrary number. The question you must ask yourself is not, what is the best risk-to-reward ratio? The question is, what system can I execute consistently without psychological collapse? Be brutally honest with yourself. Can you truly stomach 10 losses in a row and execute the 11th trade flawlessly? If the answer is anything but an immediate, resounding yes, then you are in the wrong system. We've been sold a fantasy, the fantasy of the heroic trader, enduring immense pain for that one glorious home run trade that makes it all worthwhile. It's a lie. The real heroes of this business are not the gamblers, they are the craftsmen. The ones who show up every day, execute a simple, high-probability edge with discipline, and calmly build their account one brick at a time. The path to consistent profitability is not paved with soul-crushing losing streaks and euphoric jackpots. It's paved with frequent, modest wins that keep your psychology stable, your confidence high, and your equity curve moving in the only direction that matters: up and to the right. So my challenge to you is this: stop chasing ratios, start chasing consistency. Open your trading journal, look at your past trades. How many times did a trade hit a 1-to-1 target before reversing and stopping you out? I'm willing to bet you'll be shocked. That is your untapped edge. That is your path forward. Build a system you can actually live with. One that nurtures your confidence, not one that shatters it. One that builds a career, not a casino habit. Because the best trading system in the world isn't the one with the highest hypothetical profit factor on a spreadsheet. It's the one you'll still be here, trading calmly and profitably a year from now. The professionals know this secret, and now, so do you.